Many financial experts praise the benefits of index funds. But if you're new to investing, you might not know what an index fund is or why it is better than the other options. Just like there is no one best of anything in the realm of personal finance, the same cannot be said of the best of index funds. Your own circumstances should be taken into account while deciding on the optimal index fund. But we can point you in the right path. Simply put, index funds are a type of passive investment. They follow an index with the intention of duplicating the index's performance after fees. Conversely, managers of active funds pick individual securities with the goal of outperforming a benchmark. Of course, not all index funds are created equal. The finest ones succeed in meticulously tracking their indexes, minimizing costs, and following sensible rule-based indexes. In today's video, we will talk about 2 index funds that every investor should have in their portfolio to achieve the maximum amount of financial independence. Now, let's get right into the video. What is an index fund? An index fund is a type of mutual fund or exchange-traded fund or ETF that holds all or a representative sample of the securities in a given index, with the purpose of closely mirroring the performance of that benchmark. The S&P 500 is probably the most well-known index, but there are indexes and index funds for almost every market and investment strategy you can think of. You can buy index funds through your brokerage account or directly from a company like Fidelity that sells index funds. When you buy an index fund, you get a wide range of securities in one easy, low-cost investment. Some index funds let you invest in thousands of different securities through a single fund. This helps to lower your overall risk by spreading it out over a large number of different investments. By putting your money into several index funds that track different indexes, you can build a portfolio that has the right mix of assets. For example, you could put 60% of your money in index funds that invest in stocks and 40% in index funds that invest in bonds. Most of you already know that Vanguard is the low-cost leader in its field. If you want to buy an ETF that doesn't cost much, this is the place to go. Most of Vanguard's products are simple index funds and sector ETFs, but they also have a few dividend and theme-based products. But I want to focus on 2 ETFs in particular, a pair that, when put together, can give you a fully diversified portfolio. Well, almost, but we'll get into that in a bit. This is about as simple as it gets. Let us examine those 2 ETFs. Vanguard Total World Stock ETF or VT. Most investors have heard of the Vanguard Total Stock Market ETF or VTI. It is the 3rd largest ETF in the world, but it only invests in the US stock market. The Vanguard FTSE Developed Market ETF or VEA and the Vanguard FTSE Emerging Markets ETF or VWO are good at covering international markets and manage nearly $200 billion between them. VT is basically a combination of the 3 all-in-one ETFs. The annual fee is only 0.08%. It was 0.10% a few years ago, so it's gotten cheaper over time. In terms of the breakdown, VT is roughly 60% North America, which consists of 58% United States and 2% Canada, 30% developed foreign markets, and 10% emerging markets. I know that many US investors tend to favor their own country and would rather have their US equity allocation between 80 and 90%, if not 100%. Given how stock markets returns have changed over the past 10 years, I can understand that, but I think the 60, 30, 10 allocations makes a lot of sense. From a pure forward-looking perspective, both developed and emerging markets are expected to grow faster than the United States over the next 10 years, and both are 20 to 30% cheaper than the S&P 500 right now. That kind of above-average growth, below-average valuation combination is something you want to keep in your portfolio. Given that the US is the world's economic leader, it still makes sense to keep most of your equity investments in US stocks, but I don't see a problem with putting 40% of your investments in other countries. The international presence also helps balance out the fact that the United States has too much tech right now. Tech is still the largest sector in the fund, but it only makes up 20% of all assets, which is much less than the S&P 500, where it makes up about 20%. There are allocations of at least 10% in 5 different sectors. There is a good mix of cyclical and defensive sectors. As the world economy changes in the 2020s, and we start to move away from the current period of COVID effects and easy money policies from central banks, the more diversified nature of VT will be important for lowering your portfolio risk. Even though VT is an all-cap portfolio, it is still heavily focused on large-cap stocks. Morningstar says that 17% of the fund's assets are in mid-caps and only 4% are in small caps. You can use any of Vanguard's more specialized ETFs to shift your equity allocation in one direction or another. Example, less international, more small cap, etc. But VT is still a good choice for a long-term core holding. Vanguard Total World Bond ETF or BNGW. If we have the Total World Stock ETF for stocks, it probably doesn't come as a surprise that we also have the Total World Bond ETF for bonds. BNGW owns more than 16,000 bonds and is in charge for the total global investment grade bond market. Some US fixed income ETFs have lower expense ratios than BNGW's 0.06%, but nothing else even comes close in the global fixed income ETF market. The fund only has about $600 million in assets, so it is not as big or liquid as some other exchange-traded funds. The costs of trading are a bit higher here, but I wouldn't call it a big deal. BNGW is just a group of Vanguard funds put together as one. It is made up of 50% investments in the Vanguard Total International Bond ETF or BNGX and the Vanguard Total Market Bond Index ETF or BND. There are some interesting things to think about with this structure. Buying BNG and BNGX separately won't save you money on fees, but they're both much bigger and easier to trade than BNGW. If you trade more often, you could argue that the pair of bond ETFs is cheaper than BNGW. But if you want a simple, diversified portfolio, this is probably not for you. That's why I still think BNGW is the best way to get an all-in-one exposure to fixed income. If we go back to the home bias argument in this fund, you could say that the riskiest part right now is in the US bond side. With interest rates still at all-time lows, there isn't much room for capital growth, and if rates go back up and you're on the long end of the yield curve, you could lose a lot of money. Even though yields aren't much better in foreign bond markets, I see better risk-return trade-offs right now in places like emerging markets. Looking at the portfolio itself, it is made up of about 2/3 government and sovereign debt and 1/3 corporate and other notes. I would say that I'd like BNGW to have a little less exposure to government-issued debt and a little more exposure to corporate bonds, but I still think that it is fine for a core long-term holding. It won't help the portfolio's yield, but the fact that it has investments from different parts of the world helps make up for some of that shortfall. Focusing so much on government bonds does help with credit quality too. Given what's going on in the world with the COVID pandemic and how many economies are being propped up by mountains of central bank stimulus, I think it's good to have a bond portfolio that's mostly made up of notes with ratings between A and AAA. Again, the yield from such a portfolio probably won't please people who want to make money, but I like it because it reduces risk. What's missing? In the title, I said that these two ETFs gives you almost everything you need. You can see what it is if you look at the credit quality graph in the section we just talked about. This portfolio doesn't have any high-yield bonds. In recent articles, I've said more than once that I don't like the risk-reward ratio of junk bonds right now. Still, if you want to build a diversified portfolio, you should have at least some junk bonds. 10 to 20% of the total amount of fixed income seems like a good range. I've suggested the Fidelity Total Bond ETF or FBNG as a possible choice for the fixed income spot in a portfolio like this one before. It has about 10% of its portfolio in high-yield bonds and a better mix of corporate and government bonds. There are, however, two problems. The fund has almost all of its money in US bonds, so it doesn't have much to do with other countries. Second, the cost of running the fund is 0.36%. Giving up 28 basis points in fees is a deal breaker for me because the yields on fixed income ETFs are already low. If you're an investor who wants to keep things as simple as possible, VT and BNGW may be about as close to perfect as you can get. For just 8 basis points in annualized fees, you can get a fully diversified portfolio with stocks of all sizes from all over the world and a mix of both government and corporate bonds. This is a great option for set it and forget it investing, especially in retirement portfolios. Of course, it's not perfect. It doesn't have much information about real estate, and there isn't much in the way of junk bonds. If you want to make more money into this sector, you can stick with Vanguard and buy the Vanguard Real Estate ETF or VNQ. If you want to buy junk bonds, you might have to look outside of Vanguard for something like the iShares, iBox, High Yield Corporate Bond ETF or HYG. You can change the allocations, but this two ETF combination from Vanguard is a great way to set yourself up for a long-term success. So have you invested in any sorts of index funds or not? Share with us in the comments below. Also, if you enjoyed this video, give it a like and share it with your friends so we can keep making videos like this. For more content like this, subscribe to our channel. Also, be sure to check out our other videos as well. Thanks for watching.